listener, there's going to be times where you miss out, right? That's just a fact of life, not only in investment, but just in life. You're not going to be able to be involved in every opportunity. But understand that just like in life, there is an opportunity for you to invest. And honestly, the best time to invest is when you're able to. So if you're able to invest, you do it now. Do not wait for anything. Don't wait for the market to bottom out. Don't wait for the market to peak. Invest now, because whenever you start investing, it's going to naturally just go up over time anyways.
Get in. Don't think about it. If you have the money in it to invest. Investing definitely beats not investing, right?
True.
A lot of people have not invested for years, and it's really hurted you in ways that you couldn't even imagine financially. So get in the market. Get involved.
So money is all I think of. Money on my mind, 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 money on my mind. So money is all I think of.
All right. Money is on my mind indeed, you guys. Yes, this is your host, Darrin Harvey, a.k.a. the Money Counselor, and you are tuned into Financial State of Minds. And this is the show where I help you get to that bag, manage that bag, and grow that bag as best as possible. As we discuss personal finance, financial literacy, business literacy, and all things related to the power of the dollar. And we're tuned in right here to KGPC 96.9 FM, where you may be streaming it right now at kgpc969.org, or you may be listening to it on your favorite streaming platform of choice. And this is a follow-up episode, so I have to, of course, bring back unofficial co-host of the show, Maurice Shabazz. Today, how you doing today, brother?
I'm good, man. Like we build wealth every time we get on here.
Absolutely. So always appreciate whenever you can stop by and grace us with your presence. And we're just going to continue where we left off on the previous episode. So last week's episode was essentially the topic of how and where to invest in 2025. Quick recap. We talked about a little bit of everything, what you should have prepared before you invest, making sure your budget is right, making sure you're aware about your money. We talked about vehicles of investing, crypto, gold, real estate, stock market, treasury, bonds, all that stuff. So please make sure, listeners, if you have not listened to the previous episode, please listen to it, because we're just going to go right into it. Starting now. We ended that episode, and if I recall correctly, Shabazz, you were talking about the concept of any investment vehicle, or any investment vehicle that I'm aware of, over time, over 5 years, 10 years, 20 years, 30 years plus, it goes up.
Of course.
So even though we may have some down years, and it always goes up, and it always goes up higher than where you started off, no matter what you invest in. Do you want to expand upon that concept?
So investing over the next 20, 30 years, right? If you look at anything, and I do mean just about any investment vehicle, and if you did some research on the last 20 to 30 years, you see some ups and downs and some dips and stuff like that. But over time, if you look at it over the time span of 20, 30 years, over time it has only went up, right? And if you and just by understanding and having that data, you'll know that by investing over time, it will only go up over time. Yeah, you'll have some dips. It'll go down. It's going to fluctuate, but over time, it's going to go up. You don't see, if you look at charts over the last 20 years, you don't see it just going down, right? Of course. I mean, and if you do see that, that's not something to invest in, right?
Right.
So, but yeah, I think that a lot of people probably don't look. And it's as simple as a Google search, what has Apple traded over the last 20, 30 years? And if you Google that, it'll pop up and it'll show you the chart. And you can easily find out about anything that you want to invest in. And usually 9 times out of 10, the chart will pop up and it'll show the numbers and stuff like that. And you'll see what you could have potentially earned if you invested in that 20, 30 years ago, and what your investment would look like now. So I urge anybody, like I said, that's just a simple Google search.
Yeah, absolutely. And I agree with you. And I'm a research guy, so everything I I choose to invest to, I look into before I even invest. That's something we talked about in the previous episode. And then I will restate this. This is a conversation between me and you. We are financial guys. We're in the business, but we're not wealth managers. And this is not specific advice, investment advice to you listeners. It's not specific to just any one of you. This is general education, general knowledge from our perspective. So please continue to do your own research when it comes to investing in general. But you're absolutely right. At this point, I'm a stocks guy. I was in real estate, but I've since kind of really transferred over into investing into the stock market. And my particular index that I'm in is the S&P 500. You are right. Just in the 3 years. So I started investing in the S&P 500 3 years ago. Can't remember the month, but 3 years ago. And I actually just looked at it on the way to here. Mm-hmm. I'm up, I believe the percentage is in 50%, 51% around there. Mm-hmm. And that is about 4 figures of money that I'm up because I had invested 5 figures in there. And now I'm up 4 figures just in the last 3 years. Trust me, that is not a straight line going up. It is not that. There are definitely some down periods, but that's why I believe in the concept of, definitely once you put in, you hold on to it and you don't sell, like you said, as long as possible. Hopefully until retirement or literally even never. Just you never have to sell it because, like you said, it just goes up over time, especially once we get into the decades, the 10 years, the 20 years, the 30 years, the 40 years. It will, every vehicle, it doesn't matter, it will go up.
Right.
And one thing I want to preface is we did in the previous episode talk about mini vehicles, and we're probably going to talk about some more in this episode. But one thing some people feel get stressed or anxious or maybe put a little too much work into is picking the right vehicle and never investing because they're just so frozen on trying to figure out the right vehicle. Guys, just invest.
Yeah.
Invest, right? Of course, the appeal of cryptocurrency is crazy with the hundreds of percents it's gone up over the years compared to, say, maybe bonds or treasuries that average 5, 6, 7%. Or a whole life policy, which is a 5.5 or 6, right? Of course, there's some that just, they go up more. And we've talked about that in a previous episode. But the point is, if you pick something and you're invested, period, that's the goal.
Right.
That's the goal. There will always be debates. There'll probably be an episode coming at some point. Which one's better? Which one has more benefits? Whatever. But, hey, if you're with a team of people or you have a circle that's the stock market or you have a circle of friends that do real estate, you have a circle of friends that do crypto, it doesn't matter if there's a person that's just oh, no, real estate is better compared to the stock market or the stock market is not as good as the crypto, whatever. Who cares? Everybody's winning. Everyone's winning right now. If everyone threw $10,000 into any of those markets 3 years ago, you're up. You're up. So we gave you a place to start with, and I definitely, again, encourage listeners to do your own research. Just invest. Just get to the prerequisites that we mentioned. Just get to the point where you're throwing 20% of your income on a monthly basis. Just get to that point. And at a certain point, you're probably going to end up diversifying anyways. You're probably going to get to the point where you have a little bit in real estate, you have a little bit in stock market, you have a little bit in gold or crypto or whatever you choose. Right. You're going to get to that point anyways once you start investing and you continue to invest. And the strategy that I definitely want to say that I do is what we call dollar cost average, meaning that you're investing the same amount of money regardless of the market or your situation into whatever vehicle. So if you can buy the dip, cool, buy the dip. But no matter what, you're doing your $200 a month. You're doing your $300 a month. You're doing your $500 a month. You're doing it month in, month out, month in, month out. Because not only is your principal compounding, you're just adding in, month out, dollar cost per average. I believe this is even what Warren Buffett does. He just buys regularly every single month, no matter what.
He does.
And then there's some people, including him, I'm sure, that, okay, the market is down. All right, instead of dropping $500 a month, we're going to throw in several thousand, or we're going to throw in 10,000, 100,000, whatever you have to play with. But you still are dollar cost averaging per month. That is the most proven strategy if you do that. Listener, this shouldn't be a foreign strategy to you. You know why? Because you're doing it in your 401k right now. You are dollar cost averaging into your 401k right now, and it's being hopefully matched by your employer. So this is not a foreign concept. You're just going to move that avenue from the 401k retirement vehicle, and then you're just going to add it into everything else. So very important concept, dollar cost average, do that. So we're talking about now investing long term. One thing we didn't really talk about in the previous episode that I do want to talk about briefly, but I don't know a lot about it, is investing in short term. That is an option. I'm not the biggest fan of it.
Right.
I'm not. It's more, has a higher risk assessment related to it. This is a bit riskier.
Facts.
But you can invest short term. But personally, I've never really done it. So I'm going to ask you, have you ever invested into anything short term wise? Like short term we'll define as you invested in it and you plan on selling it within the first couple of years. Have you ever done that before?
Absolutely. I invested in options.
Okay. So I don't know much about it. So I'm going to let you explain to the listeners options. What's that world like?
So let me explain what options are. So instead of actually investing into the stock or buying the stock, basically what options are is the right to buy or sell a stock. Everybody know what Apple is, right? So instead of me actually investing into just the stock in Apple, I get an option on the stock to either buy it or sell it depending on where I'm predicting the market is going to go, because you can make money whether the market goes up or down or even sideways. So the difference is when you buy a stock, whereas Darrin was talking about earlier, buying and holding. Basically, you're investing in the stock and you're just holding it, and over time, and it's just going to go up over time. So when you're buying a stock, you don't have time value. When you do options, that's a contract. So if we're in the month of September. If I buy September options, right, they're going to expire the third week of the month, right? If I get October, I have more time value. If I get a November option, I got more time value. But as we get closer to that time and I don't buy or sell the rights to that stock, what happens is the time value will eat away at it if it doesn't go in my favor. So if I predict the market is going to go up and I position myself for that, basically what happens is if it doesn't go up, the sooner it goes in my favor and I sell it, if I buy or even sell it, depending on what position I have, what happens is then I make money. But if it doesn't go in my favor and I get closer to that time period where that contract expires, it might expire worthless. So it's a lot more riskier. It's a great reward. If I get 2 or 3 points on there, and my rule is I'm just looking to get 2 or 3 points on here, and once it go to that, I'm going to go ahead and end my position. I can do that, and I can make profit on that option contract, right? But if it does not, then basically I lose out. I don't own anything. I don't own the rights to that if it expires worthless, right? And that contract has ended. So that's the only thing about when you actually do short term. You have what's called time value. That is a big part of short term investing is time value.
Got it. Okay, so just asking a question because, again, no experience when it comes to options. You mentioned Apple for your example.
Mm-hmm.
Would that be a good company to do that with? Would that be a bad company? Would you pick a different company? Like, if someone's interested in options, should they go with Apple or should they go with a different company?
Some people do options on Apple. It just depends on what's going on in the market. So to break it down, if you're doing short term, you're going to have to do a lot of homework because you're going to have to predict and have an idea of where the market is going, whether it's going up or down or sideways. You're going to have to figure out where that trend is going. And that takes some studying. So they have a fundamental analyzation. They call it fundamental analyzation. What fundamental analyzation is it's the news. To make it really simple, it's the news. So let's just say Apple came out with the new iPhone and is competing against the Android the new Android that just came out. And basically the review is that a lot of people like the new iPhone versus the new Android because it has these features. It has more pixels on the camera, blah, 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 blah. And based on this news that come out, and people who actually do this for a living, they will be up early in the morning reading the Wall Street Journal online before the market opens so they can position themselves for that move when the market opens. Some people who are really strategic and do this for a living make money every day doing this kind of strategy. And then they have the technical analyzation, which is the numbers, the charts, right? So you look at what it's been trading at, and if you're doing short term, you're looking at where it's been trading at lately. You're not going to go off of where it's been trading at the last 5, 10, 15 years. You're going off the more recent activity, right? So it's a lot of people call it gambling, but investors call it investing, because even if you go to Las Vegas, right, and you say, I'm going to go play blackjack or whatever you want to play, and you just basing it on, hey, I feel I'm good at playing blackjack and I feel that I'm going to win, that's gambling. But the professional gamblers do the homework. They count the cards. They know what the odds are. And they're very disciplined in their rules. That's the difference. It's the same concept with the market. Some people say, hey, I want to invest in Apple because I just like it. But some people might sell it because something happened and Apple dropped 10, 15 points. And they'd be like, oh, I'm going to sell it. Emotion takes over. I don't want to lose out. And what happens is that the disciplined investor has a set of rules that they go by. They have done their homework and they have a set of rules. Usually, in most cases, they're going to win if they stick to those set of rules. So that's the difference between short-term investing. Longer-term investing, you don't have to do all the homework. You don't have to have all these set of rules because you're just buying and holding. And as we just mentioned earlier, it goes up over time. So long-term, I'm going to be good.
You mentioned gambling. I want to just talk about very briefly. So you kind of explained it, but I want to expand it and kind of hit it home, because I do feel a lot of people, and maybe some of the listeners, they feel investing is gambling.
Yeah.
You mentioned part of it, how it's not the same, but we were kind of talking about options. So in general, and I'll say it, you can add on to it, one, they're not the same. Investing is not the same as gambling. And I would say that any type of investing, any investment vehicle that we've talked about or we have not talked about is not the same as gambling. And I'll say why. First off, gambling is owned by, we'll use Vegas, for example. So you go to Vegas and you go to a casino. So when you're gambling, there's already rules and things that are in place where it's actually essentially rigged for you to lose, or rigged for you not to win more than lose. So you're taking a chance right there. You're walking into a scenario where statistically you're most likely going to lose. It doesn't even matter what vehicle of gambling you do. It doesn't matter if you're doing sports. It doesn't matter if you're doing slots. It doesn't matter if you're playing card games. Especially card games or roulette or whatever. They're designed in a way for a person to most likely lose, or most likely lose over repeated play sections. And the main difference, in my opinion, is gambling, when you bet on something, it's, from my understanding, every time you gamble, even if you're betting a penny, even if you're $1, quarter, $5, $10, $10,000, doesn't matter. You're betting it all. So if you lose all of it. 100% of the time. It doesn't matter if it's blackjack. It doesn't matter if it's poker, Texas Hold'em, slot machines, you name the game, sports gambling. If you put up $100 in sports gambling because you believe the Raiders are going to win and they lose, you lose that $100 completely. That's different than investing in the stock market, because you can buy a share of Apple, like we were talking about, and literally you can buy it at 8 o'clock in the morning, Eastern Standard Time, when the market opens, and then you can sell it at 5 o'clock that evening, and you're going to walk away with something. Mm-hmm. Even if that stock crashed that day, you're going to walk away with something. I've never heard of an instance where you buy a stock and then the same day it's just completely gone. Just the value is zero. It went from having a value to not having a value. I'm not saying it doesn't happen, but it's very uncommon. Or
the company would have to go bankrupt.
The company would have to go bankrupt, exactly. Yeah. Not to say that doesn't happen. They do. But that's not the whole realm of investing, like at all, which is the whole realm of gambling. When gambling, again, like we talked about, you put in 100, the Raiders lose, you lose that 100 in a discussion. So I want to make clear the air and make that important distinction. When we're talking about investing, we're not talking about something where you buy a share in Apple. Like, let's just be real, right? Apple, if you buy a share of Apple, no matter what you do with it, it's going to be valuable until the day you die. Right. Like, especially with certain companies that I know to invest in. If you buy shares of Starbucks, Coca-Cola, Bank of America, Amazon, these are all companies that stock will always have a value. It's just not likely to go out of business. I'll just say it. It's not going to go out of business. Coke is not going to go out of business.
No.
Bank of America is not going to go out of business. We've seen how they got bailed out by the government.
They're not going to let the banking system fail.
Yeah. So I kind of really wanted to speak on that because that's a comment I get a lot from people is, investing is like gambling with your money, and then there's fear associated with it. In a way, I can see how some vehicles of investing is gambling because it's highly volatile, but even in crypto, which is the most volatile lane that I'm aware of right now, you buy a Bitcoin, that Bitcoin's going to be worth something tomorrow. It may not be worth what it was today, but it will be worth something tomorrow. You want to add anything to that?
Yeah, because I hear that term used so loosely where people say, oh, that's gambling. And this is the harsh reality. Most people that have not invested and they say, oh, the stock market, crypto, oh, that's gambling. You've been gambling all your life.
Mm.
So, and you have put your money into things that give you no return in most cases, right? So if that's the case, you really have been gambling with your life, your whole entire life. And the thing is, as you mentioned before, it's very extremely rare that any stock you invest in would expire worthless. And if you see a stock go down, guess what? That's the best time to buy because you want to buy low and you want to sell high. So if that stock did go low, you want to get in when it's as cheap as possible, right? And hold it until and wait for it to go up. So investing is not gambling. There's certain mitigated risks that you take when you invest, right? You can choose where you want to do low risk, moderate risk, or high risk. It's totally up to you which way you want to go. So I just want to dispel the difference, because if it was gambling, it wouldn't be trading trillions of dollars a day. Trust me. And some of the smartest and most wealthiest people invest in it every day, all throughout the day. So it can't be gambling.
Yeah. So definitely want to make that clear. It's not gambling. We're teaching you how to make money. And I will want to expand on not gambling, but the concept of risk. That's where the two share the similarity. There is risk. Not risk of losing all your money, but there is risk, which is why in the first episode we talked about low, moderate, high risk ways of investing. One concept that I want to talk about, and it's more of a mindset, but it's true, is once you become an investor, you have to understand that by putting your money into an investment vehicle, you are risking your money to some degree.
Mm-hmm.
You are.
Right.
Again, it's not all going to go away. Like we know, we've heard the stories of 2008 and the Great Depression. And of course, I think it's like every 15 years we experience some type of significant recession.
Right.
So one, know that. I believe it's about every 15 years or so, we experience some type of significant recession, a recession that you can actually feel. we go through periods of up and down in the economy all the time. Sometimes quarterly, we'll see it. So understand that that's just how the natural nature of the markets move. It's very important that you don't get emotional with your investments. Shabazz talked about it briefly. If you want to make money, you can't be emotional with the money that you invest, period. You can be strategic about it. You can be smart about it. I'm obviously saying don't put your entire net worth and your life savings into one stock. I would definitely not advise or tell anybody to do that. But what we mentioned earlier in the first episode is you're investing money that you're not going to miss. Please don't invest money that you need to pay your bills. Please don't invest your money that is going to be your child's college fund. Please don't invest money that you may want it for another financial goal, like buying a house, unless you're trying to buy a house 10 years from now. Then you can invest money at that point. Investing is for money that you are okay if it does go all the way. It's not going to go all the way, but just in case it is, you can still pay all your bills. You still have that emergency fund. There's a mindset, but do understand that there is risk associated with any form of gambling, which is why we preface both episodes. Do your own research beyond this episode because you want to know. You need to know what you decide to invest in. I do tell people, and I tend to be a fan of low risk investments. That's why I talk about index funds. That's why we talk about real estate, because it's low risk. But there's nothing wrong with high risk investing or high risk assets. And there's definitely nothing wrong when you diversify, when you have a little bit of low, a little bit of mid, a little bit of high. There's nothing wrong with it. If anything, every wealth manager that I've talked to, they tend to mix it up. They tend to have a little bit of risk, a little bit of moderate, a little bit of safe. So, Shabazz, let me ask you. If you're trying to teach somebody or educate somebody on how they should assess their risk assessment, what would you ask them?
So if you want to assess your risk assessment is, of course, we know higher the risk, higher the reward. I think time is one of the biggest factors. How long can you keep your money invested, right? That's always one of the best questions to ask. Hey, well, I'm willing to have my money tied up for 5 years or 10 years. Now, if that's the case, this is the easiest way that I've tried to show people how to do this. Now you're willing to, let's just take 5 years, for example. Okay. You want to do low risk, but you're only willing to allow your money to sit for 5 years. Now, what you do is you can go on your smartphone. You could go to Google and pick something that you spend money with regularly. Let's say you buy Jordan, you're a sneakerhead. You buy a lot of Nike. Go see where Nike is trading at for the last 5 years. Since you're willing to allow your money to be tied up, see where they've been trading at for the last 5 years. How much have they gone up in the last 5 years? And it wouldn't hurt to go look at the last 10 or 15 years just to get a better idea. And depending on what those numbers are, then you'll have a good idea of what the risk factor is, right? And how much it could potentially grow your investment as well, right? Also, a very crucial aspect to look, and the second thing I want you to do is I want you to Google what does that company pay as far as dividends. Dividends are what a company would pay on the profit and losses and reserves. So some companies pay out dividends every month. Most pay out every quarter. Okay? So by you holding and owning stock in that company, there's a dividend that will come with that in most cases, unless you're just basically investing in an index. So you need to basically find out how much dividends they pay as well. And that should give you enough information to know what amount of risk that you're taking by investing into that particular company, right? Or that particular stock.
Yeah, absolutely. Dividends. We even talk about dividends, so we might have to talk about that if we have time And speaking of time, just reminding you guys, you're listening to Darrin and Shabazz right now on Financial State of Minds, and this is KGPC 96.9 FM, and you're listening to Financial State of Minds. We're talking investing. So risk assessment, that is a great way to find out how safe the company is, good rate. We didn't even talk about dividends. There's people who absolutely live off dividends. They invest in a way to where the companies pay solid dividends, or they have a track record of paying dividends, or there's companies that actually pay higher than normal dividends for the company. And then you mentioned index funds. There's actually index funds that are literally high yield dividends, like they're companies that are straight up an index of high yield dividends. Mm-hmm. And there are people who literally invest in that, and it's actually a great strategy for retirement. Like if you just care about the cash, like, hey, you don't care about the value of the stock, but you care about the dividends they pay out because you want to start pulling that out 20, 30 years from now, or you want to put that into a retirement account, that's a great route to go, is to look at a company's dividends or invest in high yield dividend index funds. And you can make a good, comfortable living that way as well. I've definitely met and read many people who are retired early just because they're 20, they threw their money into index funds that paid high dividends. And by the time they're 45, 50, between the principal of the stock, between what they put in when they're 401k, and then those dividends paying out, they don't even have to sell off the actual principal stock. They just sell the dividends, and then that's their salary. That's their second source of income and stuff like that. So dividends, definitely something to consider. Switching gears slightly, Shabazz, I'm going to ask you personally, when do you think it's right or it's a good idea to get a wealth manager involved?
Well, that's a good question. If you don't know anything about investing, or you have very, very little knowledge about investing, then you probably should speak with somebody who has a lot more experience, right? There's nothing wrong with dealing with a wealth manager. I encourage it, especially if you don't know too much about investing, especially when it comes to the stock market or REITs, which are basically real estate investment trusts, or even crypto. You should probably consult with somebody who has a lot more experience, and that could explain these things to you, where you could just pretty much find a good place to where you feel comfortable investing and know which path you're going to go investing, what the potential is over whatever period of time. So yeah, and that can more devise a plan rather than you just kind of freestyling and just playing around with it and just throwing magnets, at the refrigerator trying to see what sticks. So yeah, probably come up with a more devised plan for your investment strategy.
Got you. Okay, so I have an interesting answer. I actually used to be very anti-wealth manager for the longest time, even though I knew one at the time. I used to be anti-wealth manager because two reasons. One, most people, the safest thing to do is just for them to invest into real estate or an index fund and the dollar cost average.
Right.
If you do that, listener, I can't promise you, but I'll put up my own money to guarantee you that you're going to make a significant amount of money over time if you just invest into an index fund and dollar cost average. Mm-hmm. Again, you're seeing that, listener, with your retirement account, with your 401k, your 403b, you're seeing that. So we know that works. So that's just the easiest thing to do. And most of us have families, kids, husbands, wives, partners. We're too busy to do the research. So typically, if I'm doing a plan for somebody and they ask about investing, or I'm teaching them the basics of investing, I say index fund, because it's the easiest and requires probably the least amount of research compared to any other vehicle. I started to change my mind when I acquired a bit more wealth. I'll just leave it there. Like we talked about before, when I got my wealth, the first thing I decided to do was get a universal index powered life insurance policy. That's the first thing I did. I invested 6 figures into there. Then I actually spoke to a wealth manager that I was referred to by the broker who sold me that policy that I trusted. And then I had a conversation with him, very pleasant conversation, wasn't pushy. He actually advised me to invest any more money further at that point, which I was actually shocked. Like, really? You make money off of people investing with you. Why would you tell me that? Mm-hmm. But why it made sense. It came down to taxes. Mm-hmm. So I had a really good experience with him. And I told him, I said, if I ever decide to need a wealth manager, I'm going to rock with him. And the reason why he sold me was, one, he wasn't in a rush to have me invest. Two, he said, Darrin, yes, you're a financial planner. You definitely could do the research and learn enough to invest. But as wealth managers, one, it's our day-to-day. We get paid, literally, we get compensated based off of how well we invest your money. So it is our job and it's our incentive to look at these markets on a day-to-day and as analytical as possible, because that's what we're getting paid to do. Two, if you are very busy, if you are a high-income earner and you can just throw $1,000 like it's nothing per month, chances are you probably don't have time to research, right? Like if you're earning $250,000, or basically you just don't have time. So the wealth manager does that research for you on your behalf. And again, he's incentivized to do it because of the way he gets paid. And third, one thing he shared with me is, as wealth managers, they have access to vehicles or particulars of investing that a mom and pop retail or individual like us or me, we don't have access to that. So they just have access to ways of investing that you do not as an everyday person.
Sure.
So that convinced me, like, okay, when the time is right, I might throw him an amount of money to invest in. And he's right. I don't got to worry about it. As much as I enjoy investing and as much as I enjoy learning about it and learning about the markets and the company, I'm not trying to do that all day. I don't have time to do it all day. My time is spent doing other things like making financial state of minds and making plans for people and doing other things. So it makes sense from a time perspective, too, that you may want to consider a wealth manager. Now, my understanding as far as their rates, they get usually a percentage of whatever you're investing. So say you're investing $1 million you're investing, and they may charge 1%. So they would make $10,000 a year for the $1 million that you have invested for the year. That's how wealth managers typically charge. It's a percentage rate of the portfolio that they're managing for you. Is there any other ways they typically get paid, or is it just usually percentages of the portfolio?
It's usually just percentages of the portfolio.
Okay, that's what
just to expound on that. I remember a period of time where wealth managers had a really bad rap. And I think that was around the time when Madoff had the $100 billion scam, right? And I always tell people this story. And there's a lot of regulation that's been put in place since then, right? Where they don't allow people to invest so much in a certain period of time, right? And, funny thing about him is that he was the main chairman of the board for Ponzi schemes. And that's why everybody had trusted him. Like, okay, well, he's the leader of the board. So for a period of time, wealth managers didn't have the best rap. But now, like I said, it's a lot more regulation in place to where now it's a lot more safer if you actually hire a wealth manager. And you're right, they do have access to a lot of insider trader information that a lot of investments that the average person won't have. So that's absolutely true. They definitely have access to more information. That's a fact. So if you don't mind paying a percentage for somebody helping you managing your investments, then it's the way to go. And I know some good ones as well. But also, I would still urge people to get an understanding for yourself. I think some people should do some research on their own. They should. And another reason why I would recommend a wealth manager, because a lot of people be gun shy. They'll have the money to invest. And what happens is they're scared. Like, okay, I got the money, but what should I push the button on, right? Mm-hmm. I don't know if I want to do this. Is it the right time? They get to overthinking it. And then emotion takes over in most cases. And let me tell you, has anybody ever made the best decision when they were emotional?
No.
So in those cases, you need discipline when you invest. And you need to have an objective outlook when you invest as well. So I would say somebody who actually is, if you know that you're really critical at making decisions, then yeah, you probably should hire a wealth manager. You probably should have somebody with some good experience that knows the landscape that could tell you, hey, this is the way you should go, and I'm going to show you why, so that way you can make an informed decision.
Yeah, absolutely. If you guys are interested in a wealth manager, just reach out to either me individually or Shabazz individually. We both know good people that we're partnering with, and we'll be more than happy to refer you to. I do agree with your sentiment too. Even if you do start rocking with a wealth manager, do your own research. You should be understanding what he is doing with your investments, even if you don't know to the fullest extent. I have a wealth manager that I've given money to, and he's very transparent guy. So they should be that way. There shouldn't be no hiding or avoiding questions or anything like that. I know exactly what is happening to the money that I've let him manage. So definitely wealth management, I just wanted to bring that up mainly because what you said earlier, they have gotten bad reps, and for some of them for good reasons. Some definitely, we've all heard the war stories of people getting their money taken advantage of and not knowing what's going on. So it's a real thing. So definitely do your homework on the wealth manager, or I would say preferably, to be the safest, get a referral from somebody that you trust that's had a good experience with one. So I know we're coming to an end soon, but we still have some time left. There's one topic, and we got a good amount of time, that I wanted to talk about too, that I forgot, but I'm remembering now. There's an old saying, time in the market beats timing the market. Time in the market beats timing the market. So what do I mean? What I mean, listener, is some people who are interested in investing, they only want to invest during the dips or during the lows, during the downtimes. And I understand why. That's when you can get opportunities at the cheapest. You get discounts, especially with fear of missing out FOMO stuff. People are constantly trying to time the market. The reason I say the phrase time in the market beats timing the market, the data is in, and statistically, people who, even if they come in at the most expensive, if you invest, and especially if you are doing investing and holding, you're doing long-term investing, if you come in when it's high and you just dollar cost average, those returns over a 10, 20, 30 year, even a 5-year span will always beat timing the market. So that's if you have the magic ability to know when the market dips and you buy in at the low. That's if you have it. The other reason is you don't have that magic ability, listener. You don't know when the market is going to dip or go up in any significance at all. Even if you do all the research, even if you're trying to get into options, any of you're just a wealth manager, you can predict and project, but you can't know 100% sure. So I am not a fan of people who try to time the market and try to buy in only when things are low, because of those reasons stated. And two, you don't know when the lowest point is going to be anyways until it starts going back up. We saw it with the tariffs. It just kept going down at some point, and then it stopped going down, and it went up, and it went higher than where it started. So that was the last time we saw the kind of drop off. So definitely, guys, I know some of you are listening thinking about timing the market, or you have this FOMO of, oh God, well, I missed it. Insert error, right? I missed it during the tariff stuff when it got announced in March. Oh, I missed it during the pandemic. I missed it during the 2008 crisis. Listener, there's going to be times where you miss out, right? That's just a fact of life, not only in investment, but just in life. You're not going to be able to be involved in every opportunity. But understand that, like in life, there is an opportunity for you to invest. And honestly, the best time to invest is when you're able to. So if you're able to invest, you do it now. Do not wait for anything. Don't wait for the market to bottom out. Don't wait for the market to peak. Invest now, because like we talked about at the top of the episode, whenever you start investing, it's going to naturally just go up over time. Anyways, it's going to go up over time. So, Shabazz, I want you to comment on it. Time in the market beats timing the market.
I agree. Get in. I think that's the best thing. Get in. If it's a buy and hold strategy, just get in. You know it's going to go up over time. And if you don't believe me, just go ahead and, like I said, go to Google and just see where it's traded at for the last 10, 20, 30 years. Get in. Don't think about it. If you have the money in it to invest, invest. You know, investing definitely beats not investing, right?
True.
A lot of people have not invested for years, and it's really hurted you in ways that you couldn't even imagine financially. So get in the market. Get involved.
All right. We got 5 minutes left. I'm going to throw you a fun question. You got a windfall of $1 million. What are you doing with it investment-wise?
I got a windfall of $1 million. I am going to invest, and you have to use it all for investing, right?
Investing.
Okay. So I'm going to invest in an insurance policy.
Okay.
I'm going to invest in real estate.
Okay.
I'm going to put it all under a trust. I'm going to invest in some stocks. I'm going to invest in some crypto. So I said real estate, insurance, stock, crypto, and anything that I have left over, I probably would have in a high yield savings account so I can just earn interest on extra money I'd have sitting that for emergency. So that's where I would do it. As far as percentages, I mean, that all depends. I probably would say most of it, if not half, would go to insurance and real estate off top. I'm pretty sure. And then the other portions would probably go versus emergency fund and stock and crypto.
All right. Shabazz, where can people find you?
Instagram, Maurice_Shabazz. I'm on Facebook. I'm on everything, but that's probably the easiest place to find me. I'm on LinkedIn. So, and you can really just Google my name, Maurice Shabazz, and I'll pop up. I got a ton of content on the internet.
All right. I'm going to answer that question. If I got $1 million, all right, well, I already have a policy, so I wouldn't add on to it. So we're going to skip that. But if I didn't, I would do the insurance policy, what you said. I would definitely take at least 25 to 30% of that money and investing in real estate. If I can afford to buy a multi-unit complex, I would. But we'll stick it to California. Not sure if I can afford it with a 25, 30, 50%. Probably could with a down payment. But I would get myself a 4-unit, throw down anywhere from $250,000 to $500,000 on that unit, get it paid off as much as possible, get some tenants in there. Hopefully it's a quadplex would be the goal, but we're going to do that. The remaining $500,000, I'm going to put a significant portion of it, probably about 35% at least, into the stock market. I may either do an S&P 500 or I would do what is called the Magnificent 7, which is just the top 7 companies in the S&P 500. I would just buy individual shares of those, or if there is an index fund of those, I would get that. The top 7, I believe, of the S&P 500 drives like 50% of the profit or something like that. And I would probably do about 35% of my money there. And then the remaining 15% I throw in crypto, Bitcoin. And I'd use probably Coinbase as the vehicle, but Bitcoin.
I got a question. The Magnificent 7, do they, because I'm not sure about it, so it's more of a question for myself. Do they, is that particular index, do you have to have a certain amount invested in there, or is it any kind of investment?
So I don't even know if it's an index, actually. I believe it's an index. I'm not invested in it, so I don't know the answer. My guess, though, is that like any index, you need to have a minimum amount to be invested.
Right.
Last time I checked S&P 500, it starts at $200, I believe, now. Mm-hmm. So I'm assuming with the Magnificent 7, you would need more than that.
More than that.
Yeah. So, but all right, That's it. I got 30 seconds to say the outro, which is thank you. You have been tuning in to Financial State of Minds with Darrin Harvey and unofficial host of the show, Maurice Shabazz. Thank you guys once again. I hope these 2 episodes of investment has been helpful for you. Please do your own research. And again, this is not investment or financial advice. This is for educational purposes only. You have been tapped in and tuned into KGPC 96.9. Streaming right now, KGPC96.9.org. Listening to it on your favorite platform of choice. Thank you again for listening to Financial State of Minds. Tune in for the next episode. Peace, kings, and queens. We're out here.
Invest.
Invest, y'all.